Hi, welcome to Richey May's Mortgage Industry webinar series. Today we're going to cover accounting and tax updates, specifically as it relates to the mortgage industry. My name is Nick Ward. I'm a Senior Audit Manager here at Richey May, and I will be going over some housekeeping items as we get started and introducing our panelists today. So a couple of housekeeping items are all of the participants are placed on mute. We will reserve time at the end of the presentation to address any questions you have. As they come up during the presentation, please type them into your question panel. We will compile them on our side here and then address them at the end of the presentation. If we don't have time to address the questions, we will follow up you with directly and ensure that we get those questions answered. Additionally, a recording of today's webinar as well as the slide deck will be presented to all the participants. We will send that out via email following the webinar. We would like to just put a disclaimer on this, that this presentation is not all encompassing of the accounting and tax pronouncements updates, as well as the information has been modified to best target our client base. In regards to CPE, in order to qualify for the CPE, you'll get 1 hour for today's webinar. You must answer all 3 of the poll questions. You do not have to answer the poll questions correctly to qualify, but you must submit an answer for our tracking purposes. A survey will appear on your screen following the close of today's webinar. Please take time to fill that out. We really want that feedback to make sure that this webinar series is on point and giving our clients and the participants what they need. And lastly, a CPE certificates of completion will be emailed out to participants who qualify in the coming days. So to get going, I would like to introduce to you Jennifer Hanna. She will be presenting, she's an audit partner with Richey May. She will be presenting the audit update. And Jared Frost, who is a tax partner here at Richey May, and will be talking about the tax updates. And you know, lastly, just to reiterate, if you have questions, please type them in and they will be answered at the end of the presentation. So with that, take it away, Jennifer.
All right. So my part of the presentation, we're going to go through the audit pronouncements that are new for 2017. Some things that, I guess our first part of the presentation, it will be audit pronouncements that are most relevant to our mortgage banking clients. A lot of them are a repeat from kind of last year's accounting and audit update, just because it's still applicable for the current year. New 2017 accounting standard updates, that's going to be applicable to a number of our clients. And then the last part of the presentation, I just put a broad, these are the standard updates that are out there. It may hit on a few of you, but most of you won't be affected by those changes and updates. So the first thing is equity investments. So with the exception of equity investments qualifying for equity method of accounting in circumstances where you're required to prepare a consolidated financial statement, all equity investments or equity securities are to be reported at fair value going through the income statement. This is different, and I think the primary thing that will be impacted for you all is that if you have available for sale securities that go through other comprehensive income on your statement of stockholders' equity, those changes are now going to be a hit to your P&L. These changes are going to be effective December 15th, 2017, so you'll see those changes on your upcoming audit report. So as we go through these, again, just to reiterate what Nick said, we'll be taking questions at the end of the presentation. There's also a information email address. You can send any follow-up questions if you weren't thinking of anything, and me and Jarrett will be happy to reach out and talk through any of these topics in further detail. Under equity investments as well, if you can't readily determine fair values on your equity investments, in the past you could account for these under the cost basis. That's no longer applicable. The changes in the basis of these equity investments will be recorded in current earnings. So any basis change will go through your income statement now. You know, this election only applies to equity investments that did not qualify for net asset value practical expedient. So that's, we primarily see that on the 401ks. Another thing that's going to be applicable as of 2018, and all of these effective dates are for non-public entities, will be restricted cash is now going to be shown as cash and cash equivalents on your cash flow statement. So on your balance sheet, you're still going to have a line item for cash and cash equivalents. Below that, we'll have restricted cash, but the new accounting guidance is requiring the cash flow to be the sum of the cash and cash equivalents and the restricted cash. So that'll be just a little bit of a financial statement change as of December 15, 2018. Another change is loan costs. So these aren't, you know, I think just keep in mind this isn't fair value of loans held for sale. This is more applicable if you acquire a long-term loan and there's deferred loan costs. In the past, what would happen is those unamortized net fees and costs to acquire a loan would be shown as a separate line item on the balance sheet. Now those unamortized net fees and costs to acquire a loan will be part of the loan category. So basically that loan payable balance you have on your balance sheet is going to be net of those deferred loan costs as opposed to a separate line item. This is beginning December 15th, 2020. Something to think about when you have, you know, a long-term loan or even a short-term loan if it goes over multiple accounting periods. Another thing that keeps coming up, let's answer our poll question first. Okay. So lessee accounting, this is the new lease requirements where we're basically taking all of our long-term leases and bringing them on the balance sheet. So this can be, you know, quite a lot of additional work. That's why I was curious with that poll question, how many people are considering using outside software providers to kind of track and calculate what should go on your balance sheet for your multiple leases. With this standard, and you know, since this is coming out December 15, 2019, I imagine we'll have a pretty extensive follow-up CPE, probably next summer sometime, to kind of go through this in more of a nuts and bolts standpoint, just how do you do it specifically for your company. So this will be a little bit high level, but it's a lessee will recognize on the balance sheet the present value of lease payment as a lease liability and a right of use asset. So you're going to have an asset and you're also going to have a liability. The asset is going to represent the right to use the underlying asset for the lease term. When you're measuring these assets and liabilities, lessees should exclude optional period payments such as lease extensions unless you know that you're going to exercise that extension period. So on your balance sheet, lessees will record, again, that right of use asset and lease liability for any lease that's greater than 1 year. Lessors will record the property, plant, and equipment for an operating lease and a lease receivable for a sales type or direct financing lease. The initial balance sheet amounts are going to be the same regardless of if you have an operating or a financing lease, but the variance is going to be in the depreciation pattern, and that's going to differ depending on lease classification. So your balance sheet amounts are going to vary between operating and financing leases. So new right of use assets will also be subject to impairment testing, so companies will need to provide a process for evaluating write-downs. And some things to consider in that impairment process would be, okay, I'm renting a building in this location and I'm paying $30 per square foot, but the fair market value, I can rent the same building, square footage, somewhat comparable, for $25 per square foot. So just some kind of assessment of, is there a potential impairment to that asset I have on my balance sheet? So operating leases. Just the next few slides, I'm going to go through the difference between operating and financing leases. Step one is going to be the same, regardless of if you have an operating or a financing lease. You're going to have recognition of an asset or a liability on the balance sheet, initially measured at the present value of future lease payments. For operating leases, you're also going to have recognition of a single lease cost, calculated so the cost of the lease is allocated over the term of the lease agreement on the straight line basis, which is similar to the calculation if you have a long-term lease with an escalating rent payment balance. So on your cash flow statement, all of this is going to go through your operating activities. It's just a standard lease agreement. For financing, it varies a little. The first one is exactly the same. You're recognizing your asset and liability on your balance sheet based on your present value of future lease payments. The difference is you're going to have interest expense on the lease liability, which will be recognized separately from that amortization of your financing lease asset on your balance sheet. And then also in your cash flow, you're going to have a piece for financing with the payments of the interest, and then just the regular rent payment will go through the operating section of the cash flow. So some things to consider with the leases and how it impacts your business. Just be careful when you're assessing lease buy decisions, and just make sure you're thinking about things like your debt covenant compliance. Most of your outstanding leases, again, they have to be long-term, are going to come on your balance sheet. So it's a lot more administration type activities than the prior accounting guidance. So really consider your processes, your internal control over how you account for new leases, how you stay on top of this. If you have 10 leases, it's a lot different than if you have 150 leases. And I know there's some accounting softwares out there that will calculate and keep track of a lot of this stuff for you. We're not associated with any of them, but we'd be happy to give you references from some of our other clients that use some of these software providers. And then the new assets recognized for operating leases will impact your book to tax different computation. So you're going to have differences in book to tax because of the new lease standards. And then again, CECL, current expected credit loss. This is something that keeps coming up over and over again. For Richey May client base, the most commonly impacted account on the balance sheet are going to be your mortgage loans held for investment. It's basically applicable to loans that are on your books. So under the current recognition, it allows companies to delay recognition of credit losses until a qualified event occurs and a loss becomes probable. So this is going to go into effect December 15th, 2019. So under CECL, the entire life of the loan's losses must now be taken into consideration, regardless of if you have a qualifying event. So in the past, if it was probable, if it was reasonably estimatable, you would have, your loan loss reserve based off of historical data or your current repurchase demands. But what's changing now is the provision under CECL is recorded immediately using reasonable and estimable forecast, as opposed to having a qualifying event. So we've actually had a lot of outside parties, come and, kind of talk through the services they provide for modeling, some of these credit loss forecasts. So there's a lot of outside service providers. If you have a pretty significant mortgage loan held for investment balance that, you feel like you could use some kind of outside party. We have a number of vendors that are, trying to get into this that would be happy to point you in the direction of. But some of the things with the estimable forecast is the allowances will be based on a variety of methodologies, and you can look at them either on the individual or collective pool basis. There's discounted cash flow, loss rate, roll rate, probability of default, provision matrix, loss rate methodology. You're going to measure it over your contractual term, and you're estimating prepayment speeds. There's a ton of subjective variables that go into these forecasts and models, and it's somewhat complex. So there's just a lot to think about if you have a big material mortgage loans held for investment balance on your balance sheet. So these are kind of all the things that came up prior to 2017 that are still lingering and haven't, gone into effect yet. So after this, we're going to talk about things that are somewhat new for 2017 and just, a few things to think of. The first one is derivative and hedging, targeted improvements to accounting for hedge activities. So this goes into effect 2019. One thing to consider, currently all of our independent mortgage bankers don't use hedge accounting. All of their derivatives are treated as freestanding derivatives. So, there's not a tremendous amount of work that goes in, at least from an accounting point of view or an audit point of view on, assessing a company's effectiveness of your hedge. That's something that, if you're under hedge accounting, that's a really critical part of how you, assess that transaction. And if you're in compliance with hedge accounting, this guidance is going to amend the presentation and disclosure requirements related to derivatives and hedging. And then one thing too, more financial and non-financial strategies will be eligible for hedge accounting. One example would be commodities will now be eligible for hedge accounting if it meets other criteria. Another thing is distinguishing liabilities from equity, and this is primarily related to down round features, which are typically found in warrants and conversion options embedded in debt or preferred equity, specifically for private entities. So if you have some kind of round down feature built into your warrants or conversion options, the biggest thing is it's going to trigger an equity classified freestanding financial instrument, basically when the strike price is reduced. So if you have to calculate an earnings per share, you're going to have to recognize the value of the effect of that down round feature as a dividend. And that's going to be reflected as a reduction in income available to your common stockholders, and if you're computing earnings per share. So that piece of this standard update, it shouldn't impact too many of our clients. Part two, I think, will have a little bit more of an impact. This is related to the indefinite deferral available to private companies with mandatorily redeemable financial instruments and certain non-controlling interests. So this is basically if you've created a significant pending content where you have an indefinite deferral period, it's now classified as a scope exception. So it's not going to have an accounting effect or an impact to your numbers. It's going to be a scope exception. So this one, no transaction guidance required. It is what it is. The next thing, compensation, stock compensation. So in general, modifications of share-based payment awards, this used to result in recording an incremental value arising from change in additional compensation expense. So if you had a modification of a share-based payment award, that would hit your additional compensation cost. So now the new guidance is saying if you have a modification, accounting is required only if the fair value, vesting conditions, or the classification of the reward, meaning if it's equity or liability changes, and that is a result of the change in terms of conditions. So that'll be December 15, 2017. So you're not always going to have a hit to that additional compensation cost. Goodwill. So if you have goodwill that you have to assess impairment for, beginning December 15th, 2020, step 2 is going to be removed. Step 2 is basically in your impairment test, testing the hypothetical purchase price allocation. You no longer have to do that. You just need to look and make sure that your carrying value exceeds your fair value. If your fair value is less, then you're going to have an impairment, but you don't have to go through that cumbersome purchase price allocation part of the test. This one will impact a decent number of our clients, just business combinations. It's basically the definition of what is a business. What's going to happen is the next 2 slides will kind of go over what changed in the definition of a business, but it's going to result in less transactions qualifying as a business transactions. More transactions are now going to result in an asset acquisition, which isn't going to result in goodwill. You don't have goodwill in an asset acquisition. In addition, there will be changes in the accounting for transaction costs. This business definition change is also going to impact the accounting for disposals and consolidation. So just to go over a few points of the new definition of a business is, first, it adds an upfront screen. So when substantially all the fair value is concentrated in an asset or similar assets, it's not a business. If you have some kind of holding company that doesn't have a lot of activity going on. Secondly, the acquired integrated set of activities includes a minimum requirement of an input and a substantive process that together significantly contributes to the ability to create an output. So what does that mean? What does your business do? Are you doing some kind of output? Is there some kind of, do you have a workforce? Are you creating something? Are you producing a loan that has an output of a loan that you're selling to an outside investor? One thing that comes to mind, if you're a startup company, you don't have any outputs at that point in time because you're a startup company. So there are nuances, like it must include employees that form an organized workforce and an input that the workforce could develop or convert to outputs. So that's your kind of get out of jail free card. Even if you're a startup company, you're going to have employees that are eventually going to, start developing outputs for your company. So also new in 2017, most of the things in this section are not super applicable for our client base, so I just wanted to put them on a slide just so we could get to Jared's part of the presentation a little bit faster. He has all the fun tax stuff that everybody's super interested in. So first, just income statement, reporting comprehensive income, revenue recognition, and revenue from contracts with customers. The next one is applicable to public entities being able to adopt lease accounting and revenue recognition early. 2017-10 is applicable to the government or public sector entity relating to service concession arrangements. I just wanted to say what's out there, so if there's anything that is applicable to you all, or even if it's not a direct client that we audit, we'd be happy to jump on the phone and talk through it. Receivables, non-refundable fees, and other costs, it may change the premium amortization period on callable debt securities. This will impact a lot of our clients, just the 401k stuff, compensation, changes to the presentation of benefit costs, and proposed changes to benefit plan disclosures. The next one is specifically pension plans that hold interest in master trust, but our 401k team will get something out to you all on those topics. And then our last slide is just other income, gains or losses from the derecognition of financial assets, accounting changes and error corrections of investments, equity method, and joint ventures, and then just some new nonprofit standards. So that's pretty much what is new from the audit side from 2017. And I'm going to turn it over to Jared for the tax update.
All right. Thank you, Jennifer. Well, if you're not already totally exhilarated and enthralled with accounting and tax, now we get to talk about the most exciting thing happening right now, which is tax reform. So I'm going to try and walk you through some of those provisions. And then also I'll touch briefly on the hurricane relief provision. Sorry, there's my slide. So before we get started, why don't we do a quick poll question regarding kind of how much interest you've had in the tax reform that's happening currently going on. Okay, so to start talking about the tax reform, before I get started, I just need to make a major disclaimer here that we are merely touching on just a handful of the provisions that are included in the proposed bills by the House and Senate. So as you can see on the list here on this slide, we've got 1, 2, 3, 4, 5, 6, 7, maybe 8 of the provisions. Just to put this in context, I think the House bill was about 429 pages long. I think the Senate bill, not to be outdone, was about 468 pages long. I looked and found a summary that was drafted by the House Ways and Means Committee. It was 82 pages long. That was the summary. So as you can see, this tax reform bill is extensive. There's lots and lots and lots and lots of provisions that are included, and it would probably take me a couple of weeks of webinars to try and get through all of them. So really trying to focus in on the ones that we think will have the most general application to all of you and those that you work with and for, and are mostly related to some of the key business provisions that are contained in the bills. So we're going to touch on what they're doing with the corporate tax rates, pass-through income, the tax rate, and / deduction. I'll give a little bit more clarity on that. The Section 179 expensing, bonus depreciation, taxable year of income inclusion, which was kind of a monkey wrench that was thrown at us last minute last week when the Senate was debating their bill, and something good came out of that, and I'll highlight that when we get to that topic. Limitations on business interest expense deduction, and then a couple of individual provisions, but I think applicable to our mortgage clients, the mortgage interest deduction and the sale of a principal residence. So corporate tax rates. So currently corporate tax rates, there's a tax bracket system that most people are probably familiar with. The rates range from 15% to 35%. So those corporations that have significant taxable income are paying tax currently at a 35%, essentially flat tax rate. The proposals by both the House and Senate would reduce these rates to a flat 20% rate. The only difference really between the two proposals is the effective timing. So the House would like to see this portion of the bill enacted starting in 2018, whereas the Senate is proposing to delay it for 1 year until 2019. Now the one that's probably most applicable to you on this webinar, the pass-through income tax rate / deduction. So technically this is an individual provision, not a business provision, because as you all know, if you're an owner in a pass-through entity, either a partnership or an S corporation, the income passes through to the owners and the tax is paid by the owners of the S corp or partnership. So the House and Senate really have drastically different ideas as to how to handle pass-through income. In the House's proposal, their recommendation is that they employ a maximum tax rate of 25% on pass-through income. And so what that means is that you would pay tax on your pass-through income at your marginal rates. Could be lower rates such as 10, 12, you know, 20%, but that you would not pay tax at the higher rates, which go up to currently as high as 39.6%. You would not pay tax at those rates on your pass-through income. And so this rate would apply to 100% of passive business income and then 30% of active business income, and I'll clarify that here in a minute. But just to distinguish between passive and active, it really depends on if the owner is what we call materially participating in the operations of the business. So the general rule is at least 500 hours a year. So if the owner provides services as essentially as an employee of the company for at least 500 hours during the year, they are considered to be actively participating or materially participating in the business and would not be subject to the passive income rules. So it's kind of interesting that they would allow 100% of passive business income to be subject to this rate, but they're limiting the amount of active business income. So there's a couple of elections that can be made. The general election would say that you take 30% of your active business income, and that would be the amount that's subject to the lower rate. The other 70% would be subject to your marginal rates, which could be as high as 39.6%, or I think under the Act it's actually 35%. If I remember correctly. Check that real quick. No, it's still 39.6. I apologize. Still 39.6. The other option, other than electing just the 30% of business, is that there's a methodology for calculating what they call a capital percentage, and it kind of gets complicated, so I'm not going to try and go through that over on this webinar. But for those that are in capital-intensive businesses, and we think that our mortgage clients would fall into that category, there may be an opportunity to increase this percentage from 30% to something higher than that. So you'd have to go through the calculation to kind of figure out what that capital percentage would be, and then that would be the amount of active business income that would be subject to this maximum rate of 25%. And the House, again, would like to make that effective in 2018. So the Senate kind of took a different approach with respect to dealing with pass-through income. Their proposal was that a deduction would be implemented, and that deduction would be equal to 23% of the qualified business income. So, and what is qualified business income? It's essentially business income other than investment income, and there's also exceptions for reasonable compensation and guaranteed payments. So you would take your business income, you would back off any investment income. Generally, that's the type of income that would be separately stated on your Schedule K or K1. So you would take essentially your ordinary business income, you would add back any compensation for the owners and or guaranteed payments paid to the owners, and that would give you your qualified business income. You would take 23% of that as a deduction, and then you would pay tax at the ordinary rates on everything else. So again, very kind of different approaches between the House and Senate as to how to tackle the taxation of pass-through income on a go-forward basis. The next item is Section 179 expensing. So just for those that may not be fully aware of what these rules deal with, so this deals with capital expenditures for tangible personal property. So if you're buying computers, desks, office furniture, things of that nature, there has historically been this Section 179 that would allow you to expense currently up to a certain amount of those additions. You would be able to expense those currently rather than having to capitalize and depreciate them over some period of time. So currently, this 179 expensing election is $500,000, and the phase out begins at $2 million. So if you have more than $2 million of qualified capital expenditures for essentially fixed assets that would qualify for Section 179, it reduces dollar for dollar once you get above $2 million. So once you get to $2.5 million, you can no longer take advantage of the Section 179 expensing rules. So the House and Senate have both laid out proposals as to what they would like to see happen with this particular expensing election. The House would like to increase that limit up to $5 million per year from, like I said, currently $500,000, and the phase out of $20 million. So once you got to $25 million, you would not be able to take advantage of this. But if you're below the $25 million threshold in any year, and especially if you're below the $20 million threshold in a year, you could elect to expense currently up to $5 million of capital expenditures. And that would be effective for years 2018 through 2022, and then it would revert back down to the current levels. The Senate has more of an ongoing provision that would be effective in 2018, and there's no year when this provision would cease. So their proposal is that they would allow you to expense up to $1 million of capital expenditures that qualify for 179 in any given year, and the phase out would begin at $2.5 million. So once you got to $3.5 million, you would not qualify for this election. The other somewhat related provision of the bills relates to bonus depreciation. So here the bills are much more similar. Both of them want to provide for a temporary 100% deduction for bonus depreciation. And again, this would be for qualified expenditure similar to the 179. The rules are slightly different, but for the most part, it's similar types of property that would qualify for both 179 and bonus depreciation. So under both proposals, it would apply to, property acquired between September 27th of 2017 and December 31st of 2022. So property acquired during that period would qualify for this 100% bonus depreciation. The Senate also tacked onto that that starting in 2023, you would be able to take 20% less or 80% of currently as a deduction, and then you would have regular depreciation on the remaining 20%. And that percentage decreases 20% each year from 2023 through 2026. So in 2023, the proposal would be that it would be 80%, 24 would be 60%, 25 would be 40%, 26 would be 20%, and then in 2027, that provision would sunset and the bonus depreciation rules would go away. So this is the provision that really kind of threw us for a loop last week when we found out that the Senate kind of tacked this in. This was not in the House bill, but was a provision that was added to the Senate bill. So what this deals with is the taxable year of income inclusion. So currently, there's very specific rules in the tax law that determine when you are required to include income as taxable income in any given period. So for a cash basis taxpayer, that's generally when the cash is actually received or payment is received. For accrual basis taxpayers, it's when it's properly accruable under tax law. The House bill just would have those rules remain intact, but the Senate bill had added this provision that would indicate, or that would state that the income should be recognized for tax purposes no later than the tax year that is taken into account on an applicable financial statement. And the applicable financial statement is defined, but generally all of our mortgage clients are filing an applicable financial statement. So what's the potential impact? Well, the one that kind of came front to mind for most in the industry would be mortgage servicing rights. Because as most of you probably know, for mortgage servicing rights, for GAAP purposes, there's a bifurcation of the basis of the loan between the mortgage servicing right that's retained and the loan that's being sold, and it results in additional gain on sale being recognized for GAAP or book purposes. For tax purposes, to the extent that that mortgage servicing right represents what we call normal servicing in the tax world, we don't do this bifurcation of basis, which means that from a tax perspective, you are utilizing your entire basis in the loan when it's being sold, and as such are recognizing less gain on the sale of that loan. So this rule would all of a sudden make it so that you have to do the same bifurcation process of your basis when you sell a loan, and would result in the additional income that's being recognized for book purposes would now also be recognized for tax purposes. So obviously this caused great concern in the industry, because all of a sudden you've got to come up with dollars to pay taxes on income that you have not received cash for, and that you potentially will not receive cash for years and years and years to come, potentially up to 30 years from now, if you were to hold on to that mortgage servicing right during the entire term of the loan. So we at Richey May launched a campaign, and the mortgage, we should give credit to the Mortgage Bankers Association as well. They launched a campaign to have those in the industry contact their senators and, really point out the weakness in this rule, especially as it relates to mortgage servicing rights. And I'm happy to report that the final Senate bill did include an exception for MSRs. So thanks to the efforts of the MBA and Richey May and all of our clients and reaching out to senators, we were able to get that exception into the bill. So the current treatment of MSR stays intact under the Senate proposal, and we'll kind of see what happens in reconciliation between these bills to see if this rule even stays in place or if it goes away. And that rule would be effective in 2018. The other area, just to note, the other area that this could be applicable to, at least the key area that this could be applicable to, would be your pipelines. So the interest rate lock commitments and related hedges, generally for tax purposes, we're not recognizing income on those until you actually have a loan. So while it's in the pipeline phase, there's no taxable income being recognized. This rule, if implemented, would now require us to actually recognize the income on those interest rate locks and related hedges for tax purposes as well, since that is when they are recorded for GAAP or book purposes. Another key business provision in the House and Senate bills is the limitation on business interest expense deduction. So in the House bill, and the House and Senate bills are pretty similar here with a couple of exceptions. But so the proposal would be to limit your business interest expense deduction to 30% of the business's adjusted taxable income. And the adjusted taxable income is essentially the business's income without considering the business interest expense deduction. So if you took your business income and added back your interest expense, that would essentially get you your adjusted taxable income. There's a few other adjustments as well, quite a bit of nuance in this rule, but that's kind of essentially how you get to that number. And so, obviously for our clients that incur tremendous amounts of interest expense related to warehouse lines and other lines of credit, this could be, extremely applicable in limiting your ability to take a deduction for your business interest expense. The disallowed amount can be carried forward for 5 years, but the same limitation would apply in those future years. So unless you have tremendous amounts of income in any one year, you could be limited year after year after year and not be able to fully utilize carry forward amounts. There's an exception under the House bill that this rule would not apply to businesses with gross receipts. I think it's like average gross receipts over a 3-year period of less than $25 million. In the Senate bill, the same or similar exception applies, except it would be average gross receipts over a 3-year period of less than $15 million instead of 25. And then they also had some additional exceptions for certain real property businesses and certain farming businesses. So also just wanted to quickly touch on a couple of individual provisions that are relevant to the mortgage industry. So a hot one that has been spoken about for a long time is the mortgage interest deduction. So both the House and Senate bills retain the deduction from mortgage interest with some modifications. So on the House bill, the current law says that you can deduct interest on a mortgage on your principal residence and a second residence as long as the total principal on the loans is less than $1 million. So you can deduct interest related to 2 homes as long as the combined principal on those 2 loans is less than $1 million. Once you get above $1 million, the interest deduction starts phasing out. So the House bill would like to reduce that limitation to $500,000 for married filing joint filers, and it'd be $250,000 for all other filers. And they want to only allow you to apply the deduction to 1 qualified residence instead of 2. The Senate bill would retain the limit at $1 million and allow you to still take the deduction on 2 qualified residences, but they would eliminate or suspend the deduction related to home equity indebtedness. So on a home equity line of credit, you're allowed to deduct the interest associated with a loan as long as the principal balance on the home equity line is $100,000 or less. So if you have a line that's more than $100,000, you're phased out or limited on the amount of interest that you can deduct. The Senate bill would eliminate that mortgage interest deduction. The House bill would keep it, but again, the House bill would reduce the limit for your first mortgages on 2 residences to only allow for 1 residence and reduce it to $500,000. And then the final provision that I wanted to discuss today was the sale of a principal residence. So the current law allows you to exclude from income any gain on the sale of your principal residence as long as the gain is below $500,000 for married filing joint return filers and $250,000 for all others. And currently, the residence must be used as your principal residence for 2 of the last 5 years prior to the sale. So the House bill, the House and Senate bills are identical with respect to this provision, and the $500,000 exclusion would remain for married filing joint filers, and it would be $250,000 for all others. However, instead of only having to use it as your principal residence for 2 of the last 5 years, you now have to use it as your principal residence for 5 of the last 8 years. And the exclusion can only be used once every 5 years. Currently, you can use the exclusion once every 2 years, and this rule would say now you can only use it once every 5 years. And like I said, the Senate bill has the exact same provision. So that's kind of a brief overview, again, of some of the key provisions of the House and Senate bills as it relates to tax reform for 2017. Just to reiterate, these are still that since there's so many differences between the House and Senate bills, they're now in the reconciliation process of trying to reconcile all of those differences between the 2 bills before they can vote on it again and then put it on the President's desk for his signature. So still quite a bit of process to work through here before we'll have a final bill, but at least wanted to make this audience aware of some of the key provisions that are out there and some of the potential significant changes that could result depending on what bill ultimately goes into effect or is enacted by Congress. So with that, let's do our final poll question. Give you 20 or 30 seconds to answer that. Okay, just to make sure you guys are aware on this one. So the answer to that one is false. Nothing's been enacted yet. These are just bills that are currently made its way through the House and Senate, but since the bills are so dramatically different, there's now a reconciliation process. And so until the House and Senate are able to reconcile the bills and come up with one bill that both the House and Senate can approve, no law has been enacted. And and then once it goes through that, obviously it needs to go to the president for his signature and approval, and at that point it will officially become law. So I just wanted to reiterate that. I put that in the poll question just because I wanted to reiterate that at this point these rules are not in place, they're not effective, they're not applicable. None of these are applicable until 2018 anyways, but the way that they currently stand may not actually be the way they will be eventually enacted once the House and Senate get together and reconcile a bill and provide it to the president for his signature. So could see lots of changes here in the next couple of weeks. Their goal is to try and get this done before Christmas. We'll see if they're actually able to do that or not. There's some significant differences between the two bills, and so it'll be interesting in the next couple of weeks to see if the House and Senate are able to reconcile all of those differences and put forth a piece of legislation that both can approve of, that can pass the vote, and that can go to the president for his signature and enactment into law. So stay posted on that. We'll see eventually what happens. So the last thing, in just the last few minutes that we have here, that I wanted to just quickly touch on were some of the hurricane tax relief provisions that were enacted earlier this year that we know have impacted several of our clients. Whether you actually are headquartered in the hurricane disaster areas or you simply have business operations there, some of these rules may be applicable. So I just wanted to make sure that you were at least aware of them. And again, we can certainly, if you have any questions or want to try and understand the applicability to you and your business, don't hesitate to reach out to your tax team and we can help walk you through these. But some of the key provisions that came out of that tax relief bill or law was one related to casualty losses. So individuals are allowed to claim a casualty loss on property if that property was damaged or destroyed as a result of generally a natural disaster of some kind. The casualty loss rules, though, did have limitations. So in general, the loss had to be at least $100, and all of your casualty losses in any given year had to exceed 10% of your adjusted gross income before you received any benefit. So under these hurricane tax relief provisions, those rules were relaxed. The $100 limitation actually did increase to $500, so you had to have a loss of at least $500. But the greater than 10% of your AGI provision is suspended to the extent that the casualty loss was the result of one of the hurricanes. And so that will allow taxpayers who had significant damage or had their homes destroyed to be able to claim a casualty loss. And again, this is only to the extent that it's not reimbursed by insurance. But so if they had a loss and it wasn't reimbursed by insurance, they're able to claim that loss, and there's a much lower threshold that they'd have to get over in order to get some benefit on their tax returns. The other thing is that historically for casualty losses, generally it only applies to those that itemize their deductions. under these provisions, they would allow you to actually add this to your standard deduction if you're not an itemized deduction filer. Employee retention tax credit. So these provisions also provided for what they quote unquote eligible employers, and that's a defined term. We can give you more guidance on that if you're interested. If you're an eligible employer who has a quote unquote eligible employee, which generally is someone who was affected by the hurricanes in some way, the employer is actually entitled to a tax credit, and the credit is equal to 40% of the employee's wages during a specific period of time. And I can't exactly remember the period of time off the top of my head right now, but it's 40% of the employee's wages up to $6,000. So if during that period of time the employee had wages of at least $6,000, you would get 40% of that as a credit. If it's less than $6,000, you get 40% of whatever the wages were. There's also an increased limitation on charitable contributions for hurricane disaster relief. So generally, individuals are subject to a limitation. They can only contribute to charities equal up to 50% of their adjusted gross income for the year. And and then there's other limitations depending on who you're contributing to. Corporations can generally only contribute up to 10% of their taxable income to charity during a year. And those have both been lifted to the extent that you're making charitable contributions to organizations specifically designated for hurricane disaster relief. So if you're feeling generous this time of year and you want to make some additional contributions to help hurricane victims, feel free to do so as those limitations are relaxed. And those it's for contributions that were made between like August 26th, I think, of this year and December 31st of this year. So you have until the end of the month to make any additional contributions for hurricane relief. The leave-based donation programs are related to qualified payments. So there's just some relaxed rules out there that allow you to basically make donations or payments to employees, and they will not be taxable to the extent that the donations are intended to be used to help victims of the hurricane disasters. So as a company, if you have employees that were affected by the hurricanes, there's an ability to make some payments to them, and it would not be considered compensation or wages to the extent that you can document that the payment is specifically designed or designated to help them with their hurricane relief. And then finally, the tax return deadline extension. So those that were impacted by the hurricanes had the ability to have an automatic extension beyond the normal extended deadline for both personal and business returns. So the personal returns, if your individual return was due October 15th and you were properly extended and you were affected by the hurricane, you now have until January 31st of 2018 to file that return. And if you have a business return that was due either September 15th or October 15th, and it's properly extended, you also have until January 31st of 2018 to file that return, and it would still be considered timely filed. Just note that does not extend your timing for payment of your tax. The tax was still due back in March or April when your return was originally due, and so any unpaid tax will continue to potentially incur penalties or interest until actually filed. So again, that was just a brief synopsis of some of the hurricane tax relief provisions that were enacted earlier this year. So I hope that was helpful. I hope you got a little bit of information and knowledge regarding the tax reform that's currently in place. As I said, still not law. They're still kind of battling out and figuring out what the ultimate rules are going to look like. So stay tuned. We'll certainly be reaching out to our clients as we gather more information in the coming weeks. And with that, I think our hour has come to an end. But if you have any questions, if you want to launch those through the webinar, we can certainly, we'll round those questions up. we can tell who sent them and we can reach back out to you with any answers.
That's right. If you have any questions, feel free to type those in right now. If you don't get to that, you'll see our email address up on the screen right now. Please do send those in and we'll have our presenters follow up with you. Just a couple final things. Just a reminder that once we close out of the webinar, there will be a survey that appears on the screen. If you would take a couple minutes to answer that, that would be very helpful for us for future webinars. And those of you who qualified for CPE today, we will be working on getting those certificates of completion together as soon as possible. But please be patient with us. It does take us a little time to get those. They will be sent to you soon. And finally, a recording of today's webinar as well as a copy of the slide deck will be emailed to everybody today. We will try to get that out today. Most likely we'll get that out tomorrow, so do look for that in your inbox. Thanks again for joining us, and have a great rest of your day.